Welcome to the Tides of Industry show at wealthresearchgroup.com. We're approaching a fork in the road for gold as this interview is being recorded June 7th. And gold is closed near 2011 resistance line. And we're in a week away from the Fed rate decision. The rebalancing of the GDXJ is coming. I mean, nothing could be more important going into the summer than these two events, especially when the S&P 500 looks weaker than normal. We can talk about that today, and then to see the strength for the precious metals is very good. I'm joined today by one of the pillars of our industry, a mining stocks expert. If you haven't been to this guy's website, it's like the Wikipedia of the junior mining sector. It's like the first place you gotta hit, and I don't say this lightly. It's been a gold investor since 1991. I was 7 back then. He started his focus on junior mining stocks in 2004. Realized that there's not much information out there, and wrote the book Gold and Silver, a complete guide with a focus on mining stocks, and the website is goldstocksdata.com. Don Durrett, how are you, man?
Great, thanks for the introduction.
Well, no problem. Listen, it's the first time that we get to connect on the air and record, so you know everything that we've done off the air. I'd love for you to just share your passion and your research with us. And let's start with the 2016's January to August move. It was so strong, so epic. I mean, investors made a fortune. Just owning the TSX Venture was a quick double. But you and I know that some companies went up 500,000%. Many safe plays did very well, so it was great. But since August, it's been one huge bloodbath for the sector. It's just, the venture is down 60%. Individual stocks are down even more. Some of them are down less, obviously. But you know, the metals themselves haven't cratered or anything. The companies have been seeing weak volume. It's almost like investors have become convinced that the mining shares are doomed to lose, that it's not a cyclical industry. Frankly, that's a mentality that you and I know you can take advantage of by shorting some of the indexes and taking dollar cost averaging in our highest conviction companies, because we know it's cyclical. But what do you think of valuation for companies right now, and why do you think the retail participation is so low?
Well, I think it's low is because the sentiment is low. But let's go back to what you said about 2016. So from 2011, 2012, basically we peaked in 2011 at 1935 in gold, and then we started trending down from 2011, and we trended all the way until December 2015, and it got down to $1,045. And then in January of last year, in 2016, we had this breakout. So basically we bottomed. I think we did bottom at 1045, and then we had this breakout through August of last year. And then we had basically an intermediate top, and then we started down. We started down, and then it looks like that we're starting to trend higher again. It looks like somewhat of a repeat of last year, where we're starting to trend higher. So we've made a move in the last 1 month. We were down to low 1200s around May 10th. It was 1217 on May 10th. And now we've trended up and we hit 1290. Now, are we going to break out and get around above 1300? It's possible, but probably not. Gold is currently over the 200-day moving average, which is a very significant area that I always look for in the technicals. So we're over the 200-day in gold, but we're not over the 200-day moving average in silver or the HUI. So silver and the HUI is the miners index for people that don't know. So those have not confirmed. So, and the other significant number here is 1309, and some people have said 1305 to 1315. But this is a very, very important level. It's basically creating resistance. So can we break out? So we have silver and we have the HUI trying to get above the 200-day moving average. Plus, we're trying to break through this level of 1309. And then the other significant area is the dollar. And the dollar, it's trending down, but it's also trending down into significant support area. So it's right at 96. So the dollar index is the DXY, and it's right now at 96. And it has significant support from 93 to 95. So there's a chance that the dollar could actually bounce off that support and go higher. And if the dollar goes higher, then we probably won't break through 1300. We'll probably bounce off of this and we'll go back down. And I wouldn't be surprised if gold goes back down and tests the 200-day moving averages, which is right now about 1245, which will trend up a little bit to about 1250. So it's possible we could go back down and test that again. So are we going to break out? Are we going to go down? We don't know. And the key things that I always look at is economics. So I like to get into the economic numbers because for me, I mean, that's really what's going to drive gold higher is weakness in the economy.
Okay, so what's the best strategy to do right now? Cash up and just play it out as you see it? Well,
there's still... the best time to buy was last year in January by far. I mean, it was just everything was on sale. That's when you could buy producers cheap. So the producers are no longer cheap, but there's still a lot of value there. So the really high quality miners are not cheap, but you can get value, but there's still a lot of good price stocks. So there's a chance we could have a breakout here. And if we have a breakout, once we get above 1309, it's hard to say what's going to happen. But I've been saying that the last battle is going to be fought between 1309 and 1450. That's the last battle. And so once we get into that last battle, if we win that battle, you're not going to get a chance of buying these stocks cheap. So it's not a bad time to dip your toe in, but we could go lower. But once we get above, say 1400, we get above 1375, that's when you don't know what's going to happen. We could break free. Now, once we get above 1450, there really is no more support for gold. So what's going to happen, what's likely going to happen is once we get above 1450, we're going to trend to a new high, which we're going to trend to above 1930. That's what I see in the numbers.
How long would this kind of move need to play out?
It's going to happen very quickly, I believe, over, say, a 6 to 12-month period once we get above 1450. Now, how long is it going to take to get above 1450? It could happen this year, but it probably won't. But once it gets above 1450, which I'm kind of expecting next year, 2018, it'll probably take another 6 to 12 months for a new high. So if you're holding stocks, I mean, that's the one thing about, gold and silver. This is going to happen quickly. And you want to be positioned. If you're not positioned, then it's kind of like Bitcoin. You wanted to buy Bitcoin back when it was $100, $200. You wanted to get positioned early for the breakout. Now Bitcoin's at 2,900. You really don't want to buy it, right? It's going to be the same with the miners. Once the miners break out, you're really not going to want to get in. So kind of now, this is kind of, I think, because we've had this 5-year downturn and now we're starting this trend up. It could happen very, very quickly. Say the next 12, 18 months is going to be the last real chance to buy some of these miners really cheap. That said, if we get a big move in gold and silver, and I'm talking a gargantuan move, say to $150 to $200 silver, then it's kind of not too late, right? Because these miners are just going to go crazy. You have a mania phase. But but if we're talking about $35, $40 silver, then they're kind of pricey. But once you get to 100, 150, then everybody's going to be jumping in, of course. But you still want to kind of get positioned now, I think, for some of these big moves. Potential.
Yeah, Don, what we've seen is that it's sort of a situation where it's dead money, but then it breaks out and all that period. You're just saying it's a good thing I was there when it happened and positioned ahead of time instead of chasing this and not knowing if I'm what I'm doing so much.
Let's talk a little bit about this concept of dead money and this concept that gold and silver have no value. The reason why I like gold and silver is because of history, because of economics. So, if you look at the United States, from 1945 to 1970, we were basically the strongest economy in the world. We were generating wealth. The middle class was growing. And then in the 1970s, something broke. We got off the gold standard in 1971. We had two gold oil shocks, one in the early 70s, one in the late 70s, that really impacted the United States economy. Then you had the manufacturing sector kind of peaked in the early 1970s. Over 20% of jobs were basically, that's the reason why the middle class was so strong. And that started shrinking. And so from the 1970s till today, you've had this downward shrinking in the manufacturing industry. So now it's down to under 9%. And the middle class is shrinking. Plus debt. If you look, 1980, when Ronald Reagan got into office, our debt was under $1 trillion. We basically did not have a debt problem. Household debt was very manageable. Now it's up to $20 trillion, and it's increasing on an annual basis. The United States economy, the United States standard of living, is no longer no longer growing on wealth generation. It's growing on debt. So we are maintaining or growing our standard of living on debt, and that cannot last. And so when you say, everybody says this is dead money, I would say that the United States economy is actually in a very weakened state, and it's kind of unraveling. It's like the pillars are slowly getting pulled out, because 70% of our economy is consumer spending, but yet consumer spending has been lagging, because this whole growth since 2009 has mainly been low-wage jobs. Our full-time jobs have actually been shrinking. Small business, which is an income generator, has been shrinking. So people that say dead money have not been looking at history, have not been looking at what is kind of coming, and what is coming is a train wreck. And it's kind of inevitable. And so we've had this growth since 2009, which has been the third longest economic bull market since the Depression. And it's going to end at some point. And when it does end, all of that debt, all of that leverage is kind of going to raise its head. I really think it's going to be worse than 2007-8. And if that happens, gold and silver are going to get a bid. So ignoring gold and silver really doesn't make a lot of sense to me. I actually think physical silver is probably the best risk-reward investment you can make today.
Sure. And just to clarify, I wasn't talking about the physical metals. I was referring to the miners, to the shares. But it's definitely not having an allocated position in physical metals is a mistake. It's an insurance. It's an alternative form of money. It doesn't have counterparty risk. We don't need to repeat all the advantages of having physical gold and silver in your portfolio and allocated in a number of locations, either throughout the country or outside of the country even. Don, moving on your site, there are 725 companies which you provide analysis for. And speaking with CEOs and company builders, do you see them holding back on spending cash on exploration programs, mergers, other aggressive plays? I mean, is there a general cautious tone right now?
Yeah, I would say overall there's definitely a cautious tone. I don't think that the gold and silver mining industry is healthy at the moment. It's getting healthy, but I think that in silver, you need at least 1850 silver to be healthy. And it's really interesting that 1850, if you go back and look at the chart, 1850 went closed above and below more times than any other price point, I think, since say 2005. It's amazing how many times that number just goes over and above, over and above. I don't have an exact number, but it's been like over 25 times, I think. It's went over and above it. It's kind of a line in the sand for the silver industry, and we need to get above it. And it's been really difficult to get above it. And so when you're below 1850, the whole silver industry is definitely in a cautious mode. We really need to get to, say, $22 silver for it to be really healthy, where you're going to get a lot of money to flow in. And a lot of these companies like to be conservative. They're still nervous that we could go lower, because if Trump gets his tax bill through and he can generate some growth in the U.S. economy, then you could see gold and silver go lower. So there's definitely a cautious mode. Now, the other side is gold. And I think that gold, you need to have at least $1,300 gold to be healthy. And So a lot of the majors are healthy at $1,300 gold, but the most of the mid tiers are not. And you have more mid tiers than you have majors, and the small producers are in the same kind of boat as the mid tiers. They can make, some of them, or maybe the majority of them, can make profit at 1,300, but they're just not. They just don't have enough cash flow to really do a lot of aggressive exploration or aggressive mergers and acquisitions. So you really need to get to 1,400, 1,450, and that's why I say 1,450 is so important for the industry to really get healthy. Some people would say it's healthy now because if you look at the majors, most of the majors are probably all-in cost around 1,100. I don't know what the actual, I haven't ran the numbers, but right at, we've been low 1,200s very recently, so low 1,200s, they're still not making a boatload of money. So on the whole, we have a cautionary kind of industry. I call it unhealthy, but we're getting close to being healthy. And once you get that healthy mode, then you're going to get more investment in the sector, more money is going to come in. You're going to see more mergers and acquisitions. People are going to pay more per. You're going to see the gold get revalued in the ground. And I think once you see these higher prices, I think you're going to see a lot of money move into this. I mean, it's pretty amazing. The whole silver mining, if you add up the market caps for all the silver miners, it's under $50 billion. It's a really invested sector. A lot of opportunities there.
Don, there's a change of tune from the large investment banks. JP Morgan, Bank of America, Goldman, they're getting bullish on commodities for the first time in years. You're also seeing full employment in the US and the Fed raising rates, inflation above 2% for the first time. What's next for the US economy?
Well, I've been saying in my newsletter that I'm seeing weakness, that I don't see an uptick in the economy. I don't know why the Fed would raise rates when we're seeing a lot of weakness. Job growth, for instance, they say that job growth is a positive, but I think everybody who looks at the job numbers, they see it as something that's very flatline. Yes, we're not having mass layoffs, but I don't think we're seeing wage growth, and I don't see we're seeing growth in, like the large companies. I don't think they're adding people on. So, and look at some of the trends. It looks like that the autos possibly maybe have peaked last year in 2016, and we're having a bit of a downtrend in the autos. Also, housing. It seems like that housing, the unaffordability index it seems to be starting, because the housing prices have been going higher and higher. Some people would say that as a positive, but there's also, who can afford the houses. So last month we saw new housing actually drop, and I think a lot of that is the affordability index. So I think there's some headwinds for housing because it's starting to get expensive. Also, the higher housing prices are driving up rental rates. So the rental rates are making it hard for consumer spending. So you have healthcare and rental rates and housing are all kind of sucking the wind out of consumer spending. And you're seeing that in kind of retail sales and restaurant sales. Another big number that came out this year was the demographics. This is the first time that the 18 to 65-year demographic is actually going to shrink. And the reason why is because the baby boomers are getting older. And so the growth in the demographics is happening on the older end of the scale, and they spend less money. So you're starting to see a kind of a demographic headwind. The only thing that's really, I think, going to turn it around is if Trump can bring back some jobs, if he can do some if he can get the tax bill going through, and if he can do some trade bills, that could also help. But in the near to the medium term, I see a lot of headwinds for the economy. Also, this is a 7-year, and 7 years have been kind of nasty. I mean, if you go back all the way back to 1987, where you had that crash, the big, the 1987 crash, and then 2007 was kind of the peak of the economy, and then we started heading down in 98 and 99. We had where we had the internet bubble, and then 2007 we had the housing bubble, liquidity crisis hit, and so now here we are in another 7-year. I don't know if we're going to have a recession this year, but the end of this year, I think historically, I think you have to be a little bit nervous. The PE ratios are getting a little high, and I don't see a lot of the earnings really taking off. I think on the whole, I think you have to be somewhat optimistic for gold and silver. Starting the fear trade start to kick in a little bit. I think silver and gold, I think, are undervalued here. People are ignoring it. They're a little optimistic that the economy is going to pick up, and I'm not sure that it is. I think the one number to really pay attention to is the dollar. If the dollar, I think, is going to tell the tale about where gold's going to go. If it bounces off of 95, 94 and goes back to 100, that's probably positive for the economy, probably negative for gold.
Understood. Don, let's talk a little bit about terminology and the due diligence process that you do. How do you research companies? What's the questions you address to management teams? Just the basics that you really care about when you look at a company.
Well, the two fundamental ones, of course, is the place. Where's it located? I mean, that's, to me, is kind of the first one. I really want to build a mine in an existing area where they're already building mines, and it's kind of a safe jurisdiction. That's kind of number one. It's kind of a, if it's in a bad jurisdiction, bad location, then that's kind of that's really negative right off the top. The next one, of course, is people. Do they have a good management team? Have they done it before? That's going to that's not really going to turn me completely off, but it's going to turn me on if it's a good team. And then the next one is the project. The project it is going to be, that's going to tell me the upside potential. What's the cost? What's the economics of the project? I like to look for big ones. I look for what I call flagship projects. I don't really like small ones. I'll do a few small ones if the valuation is really there, if the upside's there. But I'm really looking for kind of big projects. When I say a flagship project, like they have 2 million ounces of gold, or at least 1.5 with exploration potential, and then in the silver side, 30 million or 30 with exploration potential, or 40 million. So I call those flagship. I like to look for flagship properties that are economic. So I look for what I call the IRR, which is your internal rate of return. I like to have after tax above 20%, and I really like it 25 or higher. So you really want to look for that for kind of the returns. The other thing that's important is I don't really like to buy really expensive stocks. So I look for valuation. So I like to look for stocks that already have a market cap somewhere between 50 and 150 million. That's kind of like the sweet spot for me. I don't really like to buy a lot of stocks over 150 because you're not going to. I'm looking for big returns. If you're going to invest in gold and silver mining stocks, you might as well go look for big returns. But I do buy stocks above that, but I just don't buy. That's not really my focus. I call that my foundation, if you will. But the stocks I'm really, looking at, really interested in doing analysis right now, because I've already gotten my foundation. I have a lot of stocks that are kind of over that limit. And then anything that's below 50 million, that's kind of your high risk area. So it's okay to delve into that, but you don't want to put a lot of money into it. So what I do is I put like 1% or 0.5% of my cost basis if I'm going to buy a stock that's under 50 million. So that comes into play as well. But the thing about investing in mining stocks is that it takes a long time to kind of understand what you're doing. So you want to read my book, because there's no other books on the market out there that explain how to do this, especially for juniors, because I've read them, and there isn't any others out there. That's why I wrote my book. So you really want to read my book, and it'll give you a lot of inside information, because it's going to take you, if you don't own any mining stocks right now, it's going to take you at least 2 years to learn how to do it. So you really want to stick with kind of physical, and you want to stick with ETFs, and kind of delve into some of these miners and kind of to learn how to do it, just in case we do have a mania and you want to play around. That's kind of the overview.
Don, where can people find the book?
Go to my website, which is Gold Stock Data. And then on my website, there's a link that says, on the bottom, it says book. So that's the easiest way to find it. And you can The other one is where you want to get it. So you can get it just about anywhere online. It's currently not in the bookstores, but it's online. So Barnes & Noble or Amazon. And you can get it both in digital or hardback or paperback.
Okay, perfect. Now, what has been you've been doing this since 1991, 26 years. What is the greatest lesson that you've learned?
Oh, I love that question. So the biggest thing that I've learned is you want to buy stocks that already have the goods. Most of my big losses have been on companies that just basically did not have good projects. If you buy a miner that has a good project, that when I say they have the goods, that means they have the resources in the ground, then the odds are that that project will get built or they will get taken out, and you won't get hurt badly. Now, even with companies that kind of have the goods, that have quality projects, if you have a bad downturn, sometimes these stocks really get sold off. Even if they're quality projects, they really get sold off, and it's pretty amazing. I mean, some of these stocks, even quality stocks, can get sold off 75%. But the ones that really kill you are the ones that get sold off 90%. And usually those ones are the ones that they don't have the goods. And a lot of people like to chase the exploration stocks, because the exploration stocks can go up 100% in 1 year, and sometimes they'll go up 200% in 1 year. They like those really fast gains. And so they'll go after these exploration stocks that have valuations anywhere from $1 million up to like 15 million. So they'll buy these really low market cap exploration stocks. And a lot of times it's because people are recommending them. And I never recommend these low cap exploration stocks unless I really like some of the early drill holes. I mean, once in a while I will, but they're pretty rare. And I will talk about the high risk, that this is a high risk speculation exploration stock. So that's what I've learned, is that don't chase drill results. You can, but I recommend you do it personally. I'm kind of very conservative in that regard. I really feel that you should chase cash flow. Because I feel that gold and silver are going to bust out. And I'm a long-term investor. I don't believe in investing in 1 to 2 years. I invest 3 to 5 years, 3 to 10 years. If you're going to buy a stock, you should look at it as a 3 window. And so I'm not going after these. I don't like to chase drill results. I mean, a good example is a company called Arizona Silver. I mean, a lot of these newsletter writers were all over it, and they had no drill results yet. And that stock dropped 7, like, I don't know, 10 cents to 80 cents or something, and then back down 75% in 1 day. So people that were buying it at 75 cents, I mean, then it crashed on them. So they were basically buying, they were chasing a trend, they were chasing a stock, people were recommending, but yet it didn't have any drill results yet. So, I mean, that's one of those ones where you're investing in a stock that does not have the goods yet. And you're just, you're basically speculating. And I don't recommend that. I don't recommend speculating per se. I like to kind of bet on higher gold prices, higher silver prices. So that's what I say, chasing the cash flow. I know this is a long answer, but I want to say one last thing. You said, what's the worst thing? The best thing that I've learned is that where you make your big money is on a company that grows. So I bought First Majestic when they had a market cap of under 200 million, but they were a producer. But then they became a growth company, and that stock went from $1 all the way to $28 because of cash flow. And I really feel that that's where you make your money is on companies that are growing.
How much of your net worth would you recommend in the physical metals? And how much would you recommend in the mining shares? And what would you do with the rest of your net worth?
Okay, so this is me personal. I'm not recommending it to other people. This is me personally. So personally, I like to have about 20% in physical. And I call that my foundation. I like to have another 20% in what I call really strong producers. So these are mainly majors or emerging majors. These are companies with kind of big market caps. So I got 40% of my money in what I call kind of foundational investments. Then I do another 20% in the mid tiers, and then another 20% in juniors, and then another 20% in cash. Or now it's kind of, because I have some in Bitcoin as well. So that's how I usually break up my portfolio. So I'm like 80% in miners, gold, physical silver. Now, I do that because I believe that we're going to get a breakout in gold and silver, but I'm going to divest out of that once we get a big breakout. And the big area that I'll divest out of is silver, believe it or not, because I believe that silver actually has a higher risk than gold. Right, but right now it's leveraged 3-to-1. We have a gold-silver ratio. We have gold at 1290. We have silver at 1750. That's a 73-to-1 differential when they're mining silver to gold at 10-to-1. So you have a 3-to-1 leverage, because I believe that silver will go back down to probably in the 30s and maybe the 20s. So you have a 3-to-1 leverage in silver. So I'm coming kind of heavy in silver, but I also feel that silver has higher risk because for this reason. There's two reasons why silver has higher risk. One is that 80% of silver that's mined that comes out of the ground is used by fabrication. And a big chunk of that is used for, all of your computers, all of your phones, anything electronic, all your automobiles, all your solar panels. So if you ever have an economic crisis, a global recession, if you will, those companies aren't going to need as much silver. So you could have a potential glut if the investors don't soak up all of that excess demand. So that's risk number one. You don't have that in gold because you just don't have that much fabrication. Only about 10% is fabrication. The other big risk is that, and this isn't in the near term. So in the near term, I think from now to $75 silver, I don't think you have a risk. But once you get to $75 silver, that's when I think you could have a potential kind of global recession, or you could have this next issue that I'm coming up. So once you get above $75 silver, I think the demand in silver is going to increase dramatically from an investor standpoint. So you could easily have a shortage in silver because there just is not enough silver coming out of the ground to go around. So what could happen is the government could say that silver is a strategic metal and that we're going to outlaw ETFs. And so if they outlaw ETFs, all of that physical silver is going to go out and go on the market and create a glut, and silver could crash. So that's why I think silver has a much higher risk than gold, but that's not in the near term. That's saying 2 years, 3 years, 4 years from now. So I will be strategically divesting out of my silver as silver goes higher and higher. So by the time silver is 150, I will have at least 50% of my investments in silver out, and maybe as high as 75% out, and I'll hold on to my gold.
Now, Don, how important is the Chinese economic growth to the price of precious metals? How correlated are precious metals with industrial metals and with China?
I think it's related because I think that China's economy creates a lot of demand, and so that's where you could get this shortage situation. So, I mean, a lot of the solar panels, a lot of the demand is out of China. A lot of your manufacturing. China is the number one producer of automobiles, for instance, by far. And every automobile uses silver. So, and I think China is the number one manufacturer in the world. So that's, I think, where you get that kind of that shortage situation. So if when China goes into a serious recession, I think as a silver investor, you have to get a little nervous that the demand for silver is not going to be as high. So from that respect, yeah, I have my eye on China. I don't know. I mean, I don't think anybody knows exactly what's going to happen to silver, as the economy weakens. Now, my personal feeling is that you're going to get a fear trade. So as the economy weakens, the bond market's going to weaken. And as the bond market weakens, especially if people dump the U.S. bonds because they start getting nervous that they're not going to get paid back. For instance, I think that once the 10-year bond gets to 4%, I think you're going to start to see big and divesting out of the bonds, because once you get to 4%, 10-year rates, the U.S. is going to have to be paying something like $700, $800 billion in annual interest payments. You're looking at a bankrupt United States, and so you're going to see a divestment out of the bonds. And so if you get a divestment out of bonds, where's the bond money going to go? It's going to go into silver and gold. So that's where the fear trade really kicks in. So you have these two things pushing and pulling each other. You have this weakness in manufacturing, weakness in the economy, in Asia, and then simultaneously you get the weakness in the bond market, and you get the fear trade. So how is that all going to unfold? It's really hard. It's a really tough call. But I think on the whole, you're going to get higher gold and silver prices, especially in the near term. So I'm really a big silver bull, gold bull in that regard.
Do you ever short any of the ETFs as a hedge?
I do not, because when I got into this, and I got into this in 1991, and I basically read a book in 1991, and it changed my whole outlook around the economy. And what the book said was that the United States was in its sunset, and it's as basically the global economy leader, it was going to fall. And it was going to fall hard. And I believed it. I believed it was going to happen. And so in 1991, I started dollar cost averaging every month, buying gold mutual funds. And that original mindset, what got me going into gold, this whole mindset that the global economy is going to run into kind of a wall, if you will, that is my philosophy. So I don't short, because that, for me, that's all short-term trading, if you will. So what I do is I position myself for this wall that I think we're going to hit. And if we do hit that wall, then I'm going to be doing really well. Now, I wish I would have bought, 1,000 Bitcoins at $10. I mean, that would have been a better position than what I've done, because it's kind of been difficult and painful to sit on, these gold and silver investments. But I still have that mentality that we are going to hit that wall, and that gold and silver is going to get higher. And for instance, once silver hits $50, $75, at that point in time, I'm kind of that guy that bought Bitcoin cheap.
Understood. Don, first of all, I really appreciate the time and your commentary. Could you tell people more about your website?
Yeah, thanks for that offer. So as Lior said, I have a website that has a lot of information. It's kind of the Wikipedia of juniors, if you will. So I have over 700 miners on there, and they're all gold and silver miners. It's basically every gold and silver miner that trades in North America, Australia, and in London is on my website. And it has a wealth of information, wealth of data. That's why it's called Gold Stock Data. And so I analyze every stock, and I give a little analysis of every stock. So you get data and analysis combined. It's the only website that does that. And for free, if you want to find out which stocks, what miners are out there, you can go on there, and there's a company on the main menu. It says company. You click on company, and if you know this company, you can go and click on it, and it'll give you a little overview of that company. It won't give you my analysis. It won't give you all the extra data on there, but it'll give you some financials, give you a little overview. So as a free site, it does offer a lot of data as well.
Perfect. And there's also a paid newsletter?
Well, yeah. If you're a member of my website, it's $149 a year. You get the newsletter free. And I really feel that a lot of people say that they like my newsletter better than any other newsletter out there. And the reason why, and you have to kind of buy into my philosophy and my mindset, which kind of is chasing value, chasing cash flow, of course. So in my newsletter, I have a top 25 list, which is companies that are the minimum of a 5-bagger. So I'm going after kind of big returns. But I also have a list of 2 to 3-baggers, which are all really high quality companies. Then I have a list of dividend stocks, lifted exploration stocks. I have all these lists in my newsletter. So it has a lot of value. And then once you get the newsletter, you get all the data that goes with it. So you can go and you can actually click, and you can go and you can do the research for any company that I recommend. So you just kind of get a double whammy. So the value of my website and newsletter combined is pretty darn high. It's pretty strong. And that's the reason why I did it. I did it for value. So I'm an investor. I created the website as a gold and silver miner. So when people go on there, they're kind of surprised, because it gives them exactly what they need. And that's the reason why. I could not manage my portfolio because I have over 100 stocks. I could not manage it without my website. People say, how could you own 100 stocks? Well, my website allows me to do that.
Perfect. Don Durrett, thank you very much.
Hey, thank you, Lior. It's been a good interview. I really appreciate it.